In recent times, mortgage rates have soared, and this has caused quite a stir amongst Americans who are now frantically searching for viable interest rates on their loans. So what's the deal with people pursuing refinancing options? Let me break it down for you. Here's an insightful fact from a source in the know. 8 out of 10 mortgage deals made this month were for refinancing. It seems that a lot of people are opting to trade in their relatively stable 3% interest rates for higher rates hovering around 8%. But why would anybody in their right mind choose to do that? It all boils down to the inability to qualify for home equity loans, which have previously been a go-to solution for the consolidation of debts and for making home improvements. This problem has now left refinancing as the only viable option for most homeowners committed to avoiding losing their homes. It's a very delicate situation, and hence the flurry of activity in the refinancing sector. Despite the challenges in the mortgage market, there is still a considerable amount of refinancing business being conducted with people that have sufficient equity and good credit. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keep us motivated to keep making you great content. Thank you. Now, back to what I was saying. It's no secret that the current climate has been tough on many businesses, with the mortgage industry being no exception. It's hard to go a day without sharing about another lender closing up shop. However, despite the challenges, individuals can still thrive in this environment. One question that comes to mind is why people would willingly go from a 3% to an 8% interest rate. It seems counterintuitive, but there are a few reasons behind this decision. Refinancing can provide some much-needed relief for those struggling to keep up with their monthly mortgage payments. By extending the loan term or adjusting other loan terms, refinancing can make the payments more manageable for struggling homeowners. Additionally, some homeowners may be able to use the equity in their homes to pay off high-interest debt or finance home improvements. By refinancing, they can access cash at a lower interest rate than other forms of financing, which can ultimately save them money in the long run. It's becoming increasingly common for people to accumulate massive amounts of debt just to keep their heads above water. Despite its negative connotations, taking on this debt is sometimes necessary in order to stay afloat and combat inflation. It's a tough reality, but for many individuals and families, going further into debt is the only option to keep up with the rising cost of living. However, it's essential to acknowledge that raising debt can be incredibly detrimental in the long term. It's easy to fall into a cycle of borrowing and repaying that can spiral out of control. So while taking on debt to keep up with the cost of living may be necessary, it's vital to manage this debt effectively to avoid financial ruin. Furthermore, it's critical to understand that not all debt is created equal. Not all types of borrowing are smart financial decisions, and certain loans can be incredibly risky, especially when the interest rates skyrocket. Have you ever wondered why qualifying for a home equity loan or a home equity line of credit is difficult? Well, various factors come into play. First and foremost, it's important to understand that to qualify for home equity financing, lenders typically require you to own at least 15% of your home outright. You may not meet the lender's eligibility criteria if you haven't paid off a significant portion of your mortgage. Moreover, other factors such as your credit score, income, and debt-to-income ratio can impact your eligibility for a home equity loan or a home equity line of credit. Lenders take a comprehensive look at your financial history to decide whether or not you're a worthy candidate for the loan. If you have a high credit score, steady income, and a manageable debt-to-income ratio, you stand a better chance of getting approved for home equity financing. Imagine living in an area where the real estate market has declined. In such circumstances, if you had only put down 10% when purchasing your home, chances are there was hardly any equity. And now that the prices are tumbling, the situation may have worsened. It's always best to put down a higher amount, like 20% if possible, as it can make all the difference in the long run. While conventional wisdom states that 20% of the total amount is the mandatory amount of down payment, it can be much more beneficial than just ticking the compliance box. Think about it. When you have put down that much, it gives you a cushion to fall back on. If a financial crisis ever hits you, you can always double dip into the equity to bail yourself out. Thus, when you have more substantial equity accumulated in your home, you'll not only have better flexibility, but you can also take advantage of that equity's multiple benefits. We're not suggesting that 20% is the ultimate or only solution, but it can provide sufficient breathing room. Applying for a home equity loan can be a situation where having the money could be useful. So, it's always smart to weigh your options and increase the down payment by just a few more percentage points in any housing transaction. One of the biggest hurdles many people face when buying a new home is the down payment. While most lending institutions require a 20% down payment, this amount can be a challenge for many to gather the necessary funds. As a result, many home buyers turn to other loan options, such as FHA loans with a low down payment of just 3 and 12%. Conventional loans with a 5% or 10% down payment may also be popular options for those looking for a more flexible lending solution. However, there is one critical drawback to these low or no down payment loans. If you ever need to pull money out of your property, you may be unable to do so without refinancing the property at a higher interest rate. Even if you were lucky enough to secure a 3% mortgage rate, you may lose that rate when you refinance. It's not just about having equity in your home. You also need a solid credit score. Specifically, your credit score should be in the mid-600s or higher to be eligible. This shouldn't be an issue if you purchased your home recently and have diligently paid your bills on time. However, if you bought your home a while ago and your credit score has taken a hit, qualifying for a home equity loan may be difficult. But why does your credit score matter? Lenders use your credit score to measure your credit worthiness and loan repayment ability. If your credit score is low, lenders may view you as a higher risk borrower and be less willing to extend credit. So what are your options if you don't have a solid credit score? Unfortunately, you may have to consider other options if you don't qualify for a home equity loan. One option may be to refinance your mortgage at a higher rate, which could result in a higher monthly payment. However, this may be the only way to access the equity in your home. The reason behind this is a concept called the debt-to-income ratio. In simpler terms, this ratio is the portion of your monthly income that pays off your debts. The maximum DTI ratio for most home equity products is 43%. This is usually where people get stuck because they've accumulated an immense amount of debt lately, particularly in the credit card department. The truth of the matter is that can't be overlooked. Lenders want to ensure that borrowers have adequate funds to pay off their debts and can afford the loan payment. Therefore, if your DTI ratio exceeds 43%, it's improbable that you'll be eligible for these types of loans. Lenders consider a debt-to-income ratio of 43% a significant risk, which may hinder you from acquiring a home equity loan. However, refinancing is still a viable option for you. The only catch is that lenders may increase your interest rate from 3 to 8%, making a huge profit in origination fees, closing costs, and interest rates from you. Bear in mind that a minimum of 15% equity is required by lenders when it comes to home equity loans. However, sometimes this may not be enough, especially in today's tight credit environment where good credit is crucial. Lenders may need more equity to secure their investment and ensure you have a good enough income to pay the bills. With high interest rates persisting for long periods, it's becoming increasingly difficult for homeowners to break even on their property investments. This means many cannot sell their homes without taking significant losses shortly. If mortgage rates exceed 8%, the situation becomes even more dire. If we look at historical data, we can see that even at high 7s, breaking even takes well over a decade. Unfortunately, there is no recorded historical data on the duration of break-even periods, but typically it ranges from 4 to 6 years. In today's real estate market, the time frame for breaking even has significantly shifted from the traditional 4 to 6 years, and now it extends to 13.5 to 15 years depending on the interest rate. This shift inherently changes the playing field for those purchasing a home. It means that individuals seeking to buy property today must strategically select location and timing. Buyers face the potential dilemma of being restricted to their homes if they cannot put down substantial down payments or acquire property in areas not appreciated in value at a rate that will support early resale. This social and economic issue is not universal, as certain markets do not present this challenge, but it needs to be seriously considered by prospective homebuyers. Longer mortgage terms increase the overall amount paid for the loan, reducing the affordability of the home. With this in mind, investing in areas with rising property values gives buyers more financial flexibility. This makes early reselling possible and potentially means less money paid overall in the long run. Thus, when deciding to invest in property, consider the housing market and the potential value appreciation of an area. Thanks for watching. Please make sure you subscribe if you enjoyed the video and leave a comment below about your thoughts on the refinancing trend.